In this clip, we're going to talk about converting cash to accrual basis accounting. And essentially what that means is that you've been recording things on your books based on when you bought them, not based on when you should be realizing those items. In this example, we're going to pretend we're a wedding cake maker. In January, we paid $50 for some supplies for a cake we were going to make in March. So because we're cash basis, what we do is we record that item on our books in January when we paid for it, and then when we get paid for making the cake, we record the $250 we made for making the cake in March. That's cash basis accounting. So if we wanted to convert that to accrual accounting, we would then have to reverse this $50 entry that was essentially a debit to expense and a credit to cash. And we would have to change it to a debit to prepaids and a credit to cash, so that we could change it to accrual where we recognize the expense for the $50 in the month of March, along with the payment that we received for making that cake and delivering that cake in the month of March. This top one is cash basis accounting, and the bottom one is accrual basis accounting.